illustration, down there. So illustration, you say ABC Limited, ABC Limited, ABC Limited issued ABC Limited issued shillings 1250 million, issued shillings 1250 million loan notes. Loan notes on 1st January 2021. January 2021. Continuation. The loan note carries an interest rate of 4.72%. 4.72%. The fair value of the loan notes on 1st January 2021 was shillings 1,000. Was shillings 1,000 million. 1,000 million. Full stop. Effective market rate was 10%. Effective market rate was 10%. Per annum. Full stop. The loan is due. The loan is due to mature on 31st December 2025. 2025. Required. Determine the value. No, that is good for them. I want to make it 12 of them. 1. Prepare amortization schedule. Prepare amortization schedule. Then extracts of profits, stock loss, and statement of financial position. Correct. So that is it. So those who are coming now, can you copy that very fast? Copy that illustration. So it says ABC Limited issued shillings 1250 million loan notes. Loan notes are just bonds. On 1st January 2021, that is when they issued the bonds. So this one here is called the face value of the nominal value, the value of the bond. So when they issued, the way we were discussing yesterday, you can issue at 1250, but when you go to the market, you find that the fair value is what? Different. So the loan note carries an interest rate of 4.72%. The fair value of the loan note on 1st January 2021, that's the same date, was 1,000. So on the stock market, on that day, they were trading at what? 1,000. The value had gone down than what you expected. The market rate for capitalization was 10%. The loan is due to mature on 31st December 2025, exactly after 5 years. So we are required to prepare an amortization schedule. So amortization is to show how you, when interest has been paid, how you keep on capitalizing the value and then we prepare P&L. So let's collect some small evidence there. So down there, what we can see, one, nominal value is 50 million. That is one thing which I can capture there. Then annual interest rate is 4.72%. Then finance cost which will be the effective market interest rate, is 10%. What else? Fair value on that date, fair value on the date they issued the bond was 1,000. Then maturity period, we can be able to see that one is how many years? 5 years. Have that. Have that now. Very good. So now, interest, something there, we are writing. Interest, no, sorry, annual interest, be specific. Annual interest should be based on the nominal value throughout the maturity period. Throughout the maturity period. You know, when you take it practical, there's no way you can present an instrument with a value of 2050. Then in the market, at the like you look at 1,000, you can no interest which should be paid or received should be constant. So that one will be 1250 times 4.72%. That is what you will receive every year. Get me that value. So per annum, this is the interest you're supposed to receive. So you have the market value and the nominal. You charge interest based on the nominal value. 59. So you get 59 per annum. You get 59 per annum. But amortization, we normally amortize the market. Remember the market when the market is then upon maturity, you will redeem. At maturity, you redeem the principal. So amortization, you just play with the market down, up, like that. But at the end of year 5, you make sure you redeem the principal, which is how much? 50. So write down there, amortization schedule. Amortization schedule. So how do we prepare amortization schedule? So amortization schedule will be prepared as follows. So let's say year, balance brought down, then finance cost is at 10%, then annual interest paid 4.72%, then balance carried down. Have that arrangement. But so here it started in 2021. So to give us 2021, 2022, 2023, 2024, 2025. 5. Is that okay? Balance brought down. I've said amortization is based on the market, the way the market is playing, but on redemption, you within the principal. So, which is the nominal. So, on that date, the balance of the bond was 1,000. That is what they say. Then, finance cost will be the percentage of the opening balance. So, this one will be 10% of this is how much? 100. But interest will remain constant at 59. So to get the closing, you take the opening, you increase the value, then you subtract the actual what? Interest. That is the interest which will be paid or received. So actually it will be constant. This one will be constant throughout. So this plus this minus this should give us 1041. Then here we have 1041. 10% of 1041 will give us, let's round off, 104. So that plus that minus 59. Get 1086. So 1086, 109, 109. So now, hey, I want you to finish. Whoever is accurate should get nil. Because at the end, everything must be paid. So at the end, you should get 0. But because you're rounding off, I will give you allowance of plus or minus 1 difference. But you get plus or minus 1, you just write nil. Please proceed. The way I know you people, those are small issues, you will get nil very fast. You can even write nil, then you come and fill in the spaces. Proceed. I'm not talking. Let's proceed. This is 11. 114. Like that, rounding off. Hata hukuwa na hisi kufunga. You never notice I never close this one. You know, at the end, we agreed how many years? 5. So at the end of year 5, you pay me the interest for that year, then refund me my principal amount. The principal amount was a nominal of 12 what? So that year, this plus this minus interest and then that one. The contract comes to an end. Put that one. You got name? Yes, analysis. That is what I wanted you to capture. So from here, we can prepare those extracts. So right there, statement of profit, stock loss, extracts. Extracts. So 2021. Extract means give us income and expenses which we are capable of seeing. We are not seeing any income. The only expense I'm seeing, so right here, expenses. The only expense I'm seeing is finance cost. So finance cost, you pick this column here, this one. So this is 100. This is 104, 109, 114, 119. You don't bring interest. Interest is always deemed to be part of finance cost. So once you have paid, you have just reduced the finance cost. So in accounting, you take the whole amount. So once you give us finance cost, don't talk of interest anymore. We want to go to the statement of financial position. So right there, statement of financial position extract. Statement of financial position extract. So 2021. So non-current liabilities. Non-current liabilities. So I'm seeing 4.72% loan notes. So is a loan. It's a loan. So which values do you capture? These ones. The closing, the balance is carried down, these ones. Those are the values you capture for every year. Balance sheet is prepared at the end. So pick the balance is carried down. So that is 1041, 1086. That other one is 1191, 0. There should be nothing balance sheets. I've tried to go extra mile. That is sufficient for that particular topic. So I want us to switch to a different topic. If you should finish today. Exam is 25th April. Sinipan. Isa na kasi rin. Saan ba kayo switch? Alright, so I want us to go to a new topic. So right there, topic. I want us to go to IS20. Check on your Google platform. You tell me what IS20 is all about. Check. Anaona IS20, IFRS 9. Check at least one. Japan. IS20 is all about what? Government grants. Yes, that is what we want to check. Government grants. In your own understanding. So that's what we want to check. So like that. Government grants. And I hope you have the course outline. You are marking those topics as we move. So government grants. This is course outline for this semester. Can you show the people at the back? Government grants and government grants. What's a grant in your own? No, not the standard definition. The way you understand a grant. What is a grant? The donation, assistance, sure. Yes. So some people they take grant with ill motive, just to give the money. That we want government to help us. Then once the money comes, it goes in wrong pockets. So the question is, when we get government grants, how should we treat it in the financial statements? Very important, very important. Also for those people working in NGOs, it's very important. You get a grant to finance the production of an asset or acquisition of an asset, either 100% grant or partial grant. How should you take it in the financial statement? That is our main concern. So we want to write as we discuss. I'm not sharing the notes, that one has to write as I read. The objective of IS20, we are writing. The objective of IS20 is to prescribe. The objective of IS20 is to prescribe accounting for, and disclosure. Accounting for and disclosure of government grants, and other forms of government assistance. Other forms of government assistance. Full stop. Subtopic down there. Not even subtopic. Just say key terms. Key terms. So there are some terms you need to familiarize yourself with as far as the standard is concerned. Number one, government. Number one is government. Your government is defined in a very funny way. Not that other one, the people and the people. No, not that one. But still the definition is always funny. You define it this way. It refers to the government. That's how we define government. Right. It refers to the government, comma, government agencies. It refers to government agencies, and similar bodies, whether local, comma, national, or international. Full stop. That is the definition of government. Number two, government assistance. Government assistance. Then you say, it is an action. Government assistance is an action by the government to provide economic benefits. To a specific entity, or range of entities, without conditions. And they can do just like that, without conditions. Full stop. I'll come back there. Number three, government grants. And I've seen them before asking students to differentiate between government grant and government assistance. So government grant is an assistance. It is an assistance by the government. In the form of transfer. Of economic resources. Transfer of economic resources to an entity. Upon compliance with certain conditions. Full stop. So, okay, read the two. So that when I explain, you understand. Can you read what is government assistance and government grant? If you can see any distinction between the two. Mostly when you look at the two, they normally resemble each other. But the main distinction between the two, an assistance is just an action by the government without any what? Condition. Can you assist with condition? Huh? Can you assist with condition? No. You can't assist with condition. An assistant, you can't assist with condition unless you have, let's say, you find your friend here, your friend who is seated next to you here. Just example, he's not feeling well. and you really need someone to pull off the jacket. Will you attach condition? I'm pulling it. However, I'll be putting on this jacket for the next 1 week. Mostly, and how it should be, assistance is always unconditional. But a grant, for you to get a grant, there must be what? Conditions. You know, assistance, for example, the government realizes that there is somewhere in where there's drought. So we want to assist these people. There's a lot of flood. We can help them to come up with bridge and all that. But when we talk of grant, you must make an application and you must show that you really qualify for the grant. So as much as you write a lot of stories, the main distinction between government assistance and government grant is that assistance is always without conditions. This other one is always conditional. Upon you satisfying some conditions. Number next, grant related to assets. Grant related to assets. Like in campus, you remember, sometimes the teacher, I'm not even sorry to say, the teacher himself or herself does not know even what he's teaching. An exam is almost. Then you get someone who understood this thing a long time ago. Then you say, let me assist you. Will that person come to assist you with condition that I'm assisting you? You don't pay me, but on one condition. If you don't pass, let's not meet. Can that be an assistance? No. Assistance is unconditional. Fanya mema. Grant related to assets, in bracket, capital grant. Capital grant. And this is the capital grants. Then you say, these are grants. These are grants. These are grants whose primary condition is that the entity should purchase, comma, construct or acquire long-term assets or acquire long-term assets. Full stop. I'll come back there. Number next, grant related to income. Grant related to income. This is known as income grant. Income grant. So this is how it's defined. Is a government grant. Is a government grant other than those related to assets. Other than those related to assets. Other than those related to assets. E.g., a revenue grant for administrative purposes. For administrative purposes. Full stop. So I can explain the two. So we have what is called capital grant and income grant. Now read fast. Can you go through your notes first? Then we can discuss. So allow me to explain this using an illustration. You want to come up with a school in the villages. You know, the villagers can come up as a team. They want to build a school for the community. True. Yes. Then they approach the government that we need a grant to enable us construct the school. So if they get the grant to construct the school, that is called a capital what? Grant. Then thereafter, after constructing the school, they realize they don't have money even to those teachers who are not employed by the government are called teachers, the one they normally hire. BOM, BOM, teachers, yes. So they don't even have money to hire those people. Then again, they approach government. You can give us money so that we can pay these other teachers who are not employed by the government. So that is not a capital grant. That is an income what? Grant. So income grant, the main purpose is to offset the expenses as the asset or as the project continues into foreseeable future. But capital grant is to help you acquire or to construct the asset. You have visitors tomorrow, and I know some people will be having visitors tomorrow. Then you don't have a fridge in your house, and visitors need to see the fridge in your house. Because when you went to visit one of them, you saw a fridge. Then you talk to someone, a friend of yours, that I need a fridge, and it goes for 50K. Then the friend, being generous enough, sends you the 50K. Then you buy the fridge. Then you ask for a cab. A cab tells you that to take it home require something like 2,000. Between you and 2,000, you only have 80 what? 80 shillings. What will you do? You call another friend. Just save me with 2,000. So between the one who gave you 50 and the one who has given you the 2, which all of them looks like grant. Huh? Which one is capital and which one is income grant? 50 is capital grant to acquire the asset. But this one for transportation, this is an administrative cost. That one becomes an income what? Grant. Subtopic. Not even a subtopic. There's one term remaining. There's one term remaining called forgivable, from the word forgive. Forgivable loans. Forgivable loans. Forgivable loans. Forgivable loans. Then you say, is a form of a loan it's a form of a loan which can be entirely or partially, which can be entirely or partially, can be entirely or partially be forgiven by the lenders. Forgiven by the lenders when certain conditions have been met. When certain conditions have been met. Full stop. And I've also seen them asking you to explain what's a forgivable loan. Students cannot fail that. Forgivable loan, even if you don't know. These are loans which can be forgiven. So from what we have said up here, which I don't want to teach, we have how many types of grants? Two: capital grant and income what? Grant. So the next question is, how do you account for them in the books? So write down there, accounting for grants. Accounting for grants. Accounting for grants. Then you say, you say this way, write number one, just write number one, it will make sense. Number one, capital grants should be offset. Capital grants should be offset against the cost of their against the cost should be offset against the cost of the assets, against the cost of the assets, against the cost of the asset, full stop. Another item, the depreciable amount of the asset, should be net of the grant, i.e., that is, grant should not be subjected to depreciation. Grant should not be subjected to depreciation. Not be subjected to depreciation. Full stop. Number 2, income grants should not be, that word not underline it or bold it up. Income grants should not be offset against the asset, the value of the asset. Income grants should not be offset against the cost or value, whichever, against the value or cost of the asset. Instead, it should be recognized as income. It should be recognized as income in the statement of profit/loss. In the statement of profit/loss. Full stop. So if it's an income grant, don't reduce the value of the asset. Take it to the books as what? Income. Why am I taking it to the books as income? To help me pay what? Expenses. Because income grant is meant to cater for the administrative cost. But if it's a capital grant, it's meant to help you overcome the initial cost of the asset. So you reduce the value of the asset so that you don't depreciate the value. We will see it in calculation. Subtopic there. Not even a subtopic. Put it in form of NB, or NB will sound better. NB. A government grant should only be recognized. When the following conditions have been satisfied. Should only be recognized when the following conditions have been satisfied. A very rampant question. Following conditions have been satisfied. Number one, if there is a reasonable assurance. If there is a reasonable assurance that the entity will comply with any condition attached to the grant. There are only two. And number two, if there is a reasonable assurance, that the grant will be received. Reasonable assurance that the grant will be received. Full stop. So those are the two conditions which must be met for you to recognize a grant. Disclosure requirements. So disclosure would need to tell us if you got a grant during the year, don't keep quiet. After preparing books, tell us that you got a grant, so that you don't walk telling people that, oh, I have a lot of money. You have a lot of money and you got Let's stop there. Number one, accounting policy adopted. Accounting policy adopted. Accounting policy adopted. Of course, we normally account on accruals basis. E.g., write e.g., accruals concept or cash concepts. Or cash concepts. You can account on accruals. Accruals means you recognize even before you receive. Cash means you only recognize when you have done what? Received. Which one is highly recommended? Accruals. Number two, the nature and extent of the government grants. The nature and extent of the government grants. The nature and the extent of the government grants. So the nature and extent, you tell us whether it is capital or income grant. Finally, any unfulfilled conditions, unfulfilled conditions and contingencies. Any unfulfilled conditions and contingencies attached to the grants. Attached to the grants. Attached to the grant. Full stop. So if there's something which you are supposed to do as far as that is concerned, which you have not done, tell us that we have not complied with this and this. However, we are planning to. Illustration. So these people, they have never examined computation on the government grant, but theory is there. So I want to bring a small question here. Then I give you a break. Then during the break, before we go to the question, you tell me the which settings in your past paper have you seen any question on government what? Grant. So you peruse for me the past paper for the theories. Then we can check them before we go to that computation. So illustration, you say, a company is in the process. A company is in the process of constructing a health facility. Of constructing a health facility. Of constructing a health facility. Full stop. The total estimated cost of the facility. The total estimated cost of the facility is shillings 100 billion. It's shillings 100 million. Full stop. The company has received 20% grant. The company has received a 20% grant from the government. 20% grant from the government. Full stop. But even nowadays, I don't know how the government is run. All the governments in the world, I don't know the world, but Africa mostly, they're very funny. For you even to get grant, you know, grant is to help. But for you to get grant, the people you will pass through them by a corruption for you to get the grant. Or have you not encountered this? For you to get this money, you must also use what? Man, they ask you, I want to help you to get this money. How much is mine? And that person is giving you help. Useless. 20% grant from the government. Full stop. The facility has an estimated useful life of 5 years. The facility has an estimated useful life of 5 years. Estimated useful life of 5 years. Full stop. Down there, the entity has a projected, not a projected. The entity has projected. The entity has projected a profit before tax. Has projected a profit before tax of shillings 50 million. Of shillings 50 million for each of the 5-year period. each of the 5-year period. Now, somebody profit before tax of 50, where do they want grant? Required, prepare extracts of financial statements, prepare extracts of the financial statements, prepare extracts of the financial statements, assuming that the grant is full colon, Roman 1, capital grant is a capital grant, and Roman 2 is what? An income grant. So you are required to prepare P&L balance sheet, assuming it was a capital grant, and also assuming it was an income grant. Ignore that question first. You go for break. Then once you come, break is 10 minutes. So the first 5 minutes is for you to rest. You rest without doing anything. You just make phone calls. Those who came in hurry, you tell people you left that I arrived well. You can start coming at 7:45 so that we move together. Then the remaining 5 minutes, peruse for me the past paper, those sittings backwards. In theory form, they have never examined computation. Anywhere they're asking government grant, note it down with the page number. I come, we check, then we do this question, then we are done. I take the break. You got any? You got? Please air it in front. Which one? Which setting? Which page? November 2018. Question 5A, page. Any other? Or we can just check that one, then we proceed. Page 65. Page 65. Page 65. It's not related. 67. But the sitting is the same. Yes, she found the sitting.
Yeah, mine is on 65, that's fine.
And they can also find the page.
Yeah.
So 67. 67 or 65, depending with which paper you are. You got it. I read. Just like that. I think relevant examples. Summarize the accounting treatment. You know now the accounting, how many marks? 4? Or 6. 6, yes, it cannot be less than. You have to tell us government grants are accounted for depending with the nature of the grant. Either, so if it is, you say, if for capital grant, for income grant, you have told you how to account for them. If it's a capital grant, you reduce the value of the asset, then you don't depreciate the grant value. This other one, so you say, for example, a grant to construct a bridge, a grant to do what, but income grant is recognized in the statement of profit or loss and should not be offset against the cost of the asset, e.g. administrative what? Grant to offset administrative expenses. Let's check this question. So just read those notes. I know they will bring government grant one of these 5 days. One of these 5 days. And if they bring computation, this is the one they will bring. But Elvis is saying also, can you check 2016 question 1B? 2016, which 2016? Let me see which fitting. Elvis, May 2016. Which page, Elvis? Question 1B page. What page you can search? Tell us the page to is whatever. Which page? Page number 91. A lady can read for us, perhaps. Read for us. Something you don't know. Hey, Ken. Is Kenya a developing economy? So they want us to define a grant. Grant is an assistance. You proceed with those other words. May be accounted for using either the income approach or the capital approach. That one we agree. Yes. Discuss. There is no argument. Just explain how they operate, and that is all. Somebody just copy pasted the question. Elvis, I know that one you just did like this. Then fine. So you just read those notes. You will not come out like that in case they ask. Let's work out this one. This question is on ACCA F7. F7 in ACCA is the equivalent of financial reporting and analysis in CPA. And I've seen CAFNEP so many times. They normally go and pick questions there and then they bring. So they have never examined computation and government grants since time memorial. One of these Fridays, they will pull that one from there and they bring. Then you say it looks so familiar. So let's revisit that question. Let's revisit that question. What are they saying? Okay, let's collect evidence. Let's collect evidence. What was the cost of the facility? 100. So cost of the facility was 100 million. Allow me to work in thousands. Then useful life. The useful life, 5 years. Then government grant, they were given a grant of what percentage? 20%. So of course, 20% of the value of the facility. So 20% of that gives you how much? 20. Sure. Yes. That one is enough. No. Annual expected annual PBT, profit before tax. They were expecting 50 million per annum for the next 5 years. Correct. That is enough for us. So they want us to prepare P&L and balance sheets for each of the approach, assuming you are using a capital approach or an income approach. So let's start with Roman 1. Assuming capital grants. So assuming capital grants. So if the grant you are given was capital in nature, then it will be this way. Depreciable amount, depreciable value, not amount. Depreciable value will be the cost minus the value of the grant. You subtract the grant so that you don't depreciate the grant, because the grant is meant to help you reduce the value of the assets. So that one you're not supposed to depreciate. So what should be depreciated is how much? 80. Therefore, annual depreciation will be 80 divided by how many years? 5 years, giving you 16. Check to confirm. So 16,000 per year. That is enough. That is enough. So right there, extract or profit stop loss. So year 1 to year 5. So year 1, year 2, year 3, year 4, year 5. Of course, shillings we have reduced to thousands. So, right there, profit before tax, they expected 50 for every year. Then you less, there was depreciation. So depreciation is how much? Still, every year. So now, the adjusted profits before tax will be 34. Not tax. Let's write this extract of the statement of financial position. So year 1. Okay. So non-current assets. Non-current assets. So non-current assets, we now have facility, or just write facility. Facility, but bring it at cost. So the cost of the facility, which you need to capture, is not the 100. 20 will say you. You recognize how much? 80. That is what you capitalize as the cost. Then you less accumulated what? Accumulated depreciation. I want you to help me to accumulate it. 16 plus that other one like that. So the first year, of course, is 16. Year 2 will be 32. Continue. 48. 48. 64. 80. So net book value. Net book value, you subtract. So this is 64. So if you're using capital approach, that is what happens. Let's see how it differs with the income. So assuming income grant. Assuming income grant. So assuming income grant, if it's an income grant, then the grant will not help you reduce the cost of the asset. So depreciation will just be based on the 100 divided by 5 years. That is 20 per what? So the grant will not help you to offset, it will help you in offsetting expenses. But this thing is funny, whichever method you take, it will always be the same. The answers should always be the same, whichever method. That is what I've never understood. Alright. So let's go to the P&L straight. So year 1, 2. So profit before tax 50. Then you add other income. Which other income do you know? Yeah. Grants. So the grant is the other income. So in income grant is recognized in P&L so that we will reduce the expenses. So the grant received was how much? 20. But now you don't utilize the whole 20 in year 1. You are expected to utilize it throughout the useful life, which is how many years? 5. So spread it across, divide by 5 years. So every year we recognize offset. Then you less accumulated what? Less accumulated depreciation. Depreciation is not accumulated, sorry. Less depreciation. We only accumulated the balance sheet. P&L for every year. So every year is 20. So 20, 20, 20, 20, 20. Can you check whether it is giving you the same answer as the other P&L? It should give you the same. Whichever approach. So we go to the, are they the same? Yes. So whichever method you pick, they will always be the same. Let's do the balance sheet for this one. So right there, extract of the statement of financial position. Then I want to change the camera. So extract statement of financial position. We want to find. Correct. So non-current assets, even this one, they have to have the end of the page should always be the same. So the facility at cost 100, we never reduced. Have that. There's accumulated depreciation. 20, 40, 60, 80, 100. Don't close down. So NBV. Hi. So NBV, this is 80. Me. Hi. Then right for me here, non-current liability. That's why here is where students normally go wrong. You know, grants are conditional. You cannot cheat the government to give you grant, then you just have that project year one, then project money. That can't apply. If you have the grant, you have seen we have spread it over the 5 years period. 4, 4, 4, 4, 4. Sure. So at the end of year 1, for accountability, you tell us how much have you utilized and how much is remaining. So what is remaining? What you have not utilized, in case of anything, that the project is suspended or you no longer do the project, then that amount is refundable. Sure. Are we together? We got 20. At the end of year 1, we should have used how much? 4. We are remaining with 16. Unutilized funds is a liability on you because in case of anything, you have to return it. So it becomes a liability. It's called deferred income. Deferred income is a liability. Deferred income is an income which you have received in what? Advance. So in year 1, your balance sheet is prepared at the end of the year. At the end of year 1, we assume that you will have utilized how much? 4. How much is remaining with you? 16. That is a liability. In case of anything, this is what you're supposed to refund. Let's go to year 2. By the end of year 2, you're supposed to have utilized how much? 8. How much is refundable? By the end of year 2, you have utilized how much? 8. Before 4, 8. So it means refundable is how much? 12. Refundable is 12. By the end of year 3, you will have utilized how much? 12. Right?
Yes.
You will have utilized 12. How much can you refund in case of anything? 8. By the end of year 4, you should have utilized 16. How much can you refund?
4.
How much can we refund? 4. By the end of year 5, we should have utilized how much? 20. How much can we refund? Nothing. Yes. Hey, I know. When you repeat this one again, have you understood? Yes. What you are remaining with is a liability. So by the end of year 1, you should have utilized 4. And you're remaining with 16. What you are remaining with is not your money. Is money which you need to do what? To pay back, which is a liability. Correct. So remember, these are liabilities, this is an asset, so you subtract. Okay. Or you say what makes you happy? Get me these values, and they should be the same with the balance sheet of the other one. They should always be the same. They're the same, huh? Yes, they should be the same. Same means 60, 64, 48, 16. Wait, 32, 16, not 36. That is it. That is the farthest I can go as far as that topic is concerned. We meet tomorrow for a new topic. I'm taking you to IS number 19. For government, it is IPSAS number 25. You will tell me this about what? Yeah? Someone has mentioned. IPSAS 25 or IS number 19. That is our new topic for tomorrow. Thank you. Do have a good night. We have a class at 11. 11, I don't have a problem. If it was 8:30, I would have advised you to sleep today. But even if you sleep tomorrow, tomorrow is any time from 12. I know 11 will be here. So there is no problem. I have a good night. Let's meet tomorrow. John is saying it's lost. John, you will understand. Just go and read slowly. You'll understand. It's not hard. You defer what you have not used. Just check. If you don't get, you'll ask.